the person who built the business is usually a remarkable talent, right? Just by definition, if you're an American entrepreneur and you build a 10, 15 million dollar business and sell it, like good for you. That's a hard thing to do. Oftentimes, most private equity wants to keep the owner by definition, as we established up front. The owner is a force of nature. He or she built this damn thing and got it to where it is. And so they don't want you all to go away in most cases. They actually want you to stay there. They want you to roll a substantial part of your equity and you get that second bite of the apple. The name of the game is to try to buy founder-owned businesses where the founder has not optimized the business. So you've got a business with 3, 4, 5 of EBITDA, and what you find generally is that in these companies, the founder tends to have come from the industry. They tend not to be somebody who's a trained, CEO. They didn't go to CEO school. They went to school of hard knocks. They did whatever the industry thing was, and they became the CEO eventually. And so what you find is that they tend to have undermanaged in terms of some pretty simple operational items. They've never pushed price increases on their customers. They've never priced their product based on value add versus just on negotiated rates or things like that. They've never looked at buying their nearest competitor down the road who might have a lot of logical synergies with them. They've never hired a real CFO who can actually give them pricing by product. Maybe half the products don't make any money, and the other half are areas you should really want to invest in. We actually bought one recently where the guy was like, I want to be paid $40 million. And we were like, was that enterprise value or equity? He's like, I don't know what that means. I want a $40 million check. And when he did the math on it, that was like 3.5 times EBITDA or something. We would have paid him 6, to be clear. We were like, oh, great. Like, where do we should close tomorrow kind of thing. So like, I think you do yourself a real disservice when you think in terms of dollars. Like you want to optimize your earnings number because that's what they're going to value. And then you can, the broker and they can compete on who wants to pay the highest multiple for that. But again, they will ding you on your multiple if they don't believe your financial statements. That's the number one issue we see. The name of the game is to try to finance as much of it as you can with cheap debt, and that's going to be dependent upon your level of durability of cash flow. And as you get larger in these companies tend to generate more scale and become more predictable, they then can attract more debt and therefore command a higher price. And so there's a pretty natural step up.
Are you basing leverage off EBITDA or revenue?
EBITDA. And so we also find you raise a good point, which is that usually as you get into the middle and upper and then the mega market, those are going to be cash flow based loans. So they're going to be based on EBITDA. In the lower middle market, we actually see a lot of companies that are initially financed with asset-based loans, because what we find is that early on, the founder within the small business construct that's never had outside money, oftentimes the founder owns the real estate as well. And so they often will sell the real estate with the business.